Okay, so good afternoon, guys, and welcome to tutorial 6. So for this tutorial, we are going to talk about the second part of international parity conditions. So to summarize the whole chapter 6, which were the international parity conditions, um, this slide basically summarizes the whole lecture. Okay. So on this slide, we have listed out all of the international parity conditions relevant for this topic. So the four circles here, the four yellow circles here, um, are the four different macroeconomic conditions, macroeconomic indicators that we are interested in. So here I've got the expected spot exchange rate. Here I've got the forward versus spot exchange rate. Here I've got the inflation rate, and here I've got the nominal interest rates. Okay, so the main purpose of chapter 6 were to talk about the relationship between exchange rates and the other different macroeconomic indicators. Okay, so their relationships are described under different parity conditions. For example, if we talk about the forward rate, the forward exchange rates, and the nominal interest rates, these indicators are related through the IRP. Okay, so through the interest rate parity conditions. Similarly, the expected future spot rate is related to inflation through the purchasing power parity condition. Okay. So in the lecture, we spend a lot of time talking about the three most important parity conditions, being IRP, PPP for purchasing power parity, and FE for Fisher effects. Okay. So one important thing to note is that these conditions are held under the assumption that the market is free and the market is efficient. Okay. So if people can freely trade, whenever they see any arbitrage opportunity, they will be able to take part in that. Through their trading, when people arbitrage away the mispricing, this is how these conditions are kept in equilibrium. Okay. So whenever you have a market friction, say for example, transaction costs or restriction to capital flow, so these frictions will prevent these conditions to be in equilibrium. Okay. So we can also write the parity conditions in approximation. So in this case, for example, for the IRP, I can write that interest rate Japan minus interest rate US is equal to the forward rate minus the spot rate divided by the spot rate. Okay. So one reason why people write the IRP condition in approximation is because we can easily tell we can easily work out the expected movement in the exchange rate. Okay. So for example, if the interest rate in Japan is greater than the interest rate in the US, so that Japan minus IUS is positive, then in this case, we can say that the forward rate is greater than the spot rate, okay? Which means that the market is currently expecting the USD to appreciate, okay? So on and so forth, okay? So in the second part of the lecture, we also talk about forecasting techniques in the foreign exchange market. So in terms of forecasting techniques, the key question we want to ask here is, what does the future look like? Okay, so how can I best predict the future? So where does the exchange rate move in the future? So in terms of forecasting techniques, we talk about three different approaches, and depending on what you believe, then you will be more inclined to one or the other approach, okay? So for example, if I think that the market is very efficient, if I think that all information has already been incorporated into prices, then the best predictor for the future is the forward exchange rate, okay? So in this case, the exchange rate follows a random walk, so it doesn't really make sense for me to to do any sophisticated calculation to work out the future exchange rate, I can just look at the forward rate and use that as a predictor for the future. Okay. So this approach is very cost effective in the sense that I just need to be able to observe the forward market. Okay. But of course, for this approach, you need to be able to assume that the market is efficient. Okay. So for some currencies, we are able to assume, we are able to make this assumption. For example, with the USD or the pounds or the Australian dollars, the information is transparent and you've got relatively free market. Okay. For some other currencies like the Japanese yen or the yuan or the Chinese yuan, the situation might be different. Okay, because these currencies are controlled by the government. So with the fundamental approach, it's a little bit different. So under the fundamental approach, you think that there are certain determinants of the exchange rate. So for example, your exchange rate could be explained by the inflation rate or the interest rate. So in this case, assume that I can identify all the important determinants of the spot exchange rate. I can then build a model, a statistical model, so that I can predict the spot exchange rate using that model. Okay. So this fundamental approach is a bit more involved. You've got to collect data, you've got to build your model, and you need to be able to do forecasting. Okay, so it's a bit more costly and it's a bit more involved, but empirical studies have found that it might not outperform the forward rate. Okay, so the benefit of the fundamental approach is not too clear. With technical analysis, in this case, you don't believe that the market is efficient. You think that there are certain patterns or trends in the past, and it is going to repeat in the future. Okay, so in this case, for example, I might think that the exchange rate moves like this. So based on what I observed in the past, the exchange rate looks like it follows a cycle. Okay, so sometimes it will peak and sometimes it will reach the bottom. And when it reaches the bottom, it will go back up. Okay, so assume that I'm currently here. So I'm currently here. This is the current time. And assume that I observe the market to move up for a while and then it starts to move down. Okay. So if this is the case, and if I believe that the past is going to repeat itself, then my prediction would be that in the future, there will be a decline in the exchange rate. Okay. So this is how I use historical data to predict the future. Okay. So my assumption here is the historical pattern will repeat itself in the future. Okay. So this was the theory for topic 6 or chapter 6. Is there any question before we move on to the tutorial? If not, I'm going to move on, okay? So for this tutorial, we have quite a lot of questions. And I think with the theory questions, the most important one is question 5. So it's a bit more involved and you need to understand question 5 to understand the importance of PPP, okay? The other theory questions are quite straightforward. So given the interest of time, I'm going to go through question 5 in class and you can look at the solutions for the other theory questions at home, okay? If there's any query or confusion, feel free to email me or talk to me in consultation, okay? So with question 5, discuss the implication of the deviations from the purchasing power parity for a country's competitive position in the world market, okay? So here we talk about PPP, purchasing power parity, and we look at the implication of deviations from the PPP, okay? So I'm going to share with you my notes and we can go through the question together, okay? At any point in time, if you have any questions, feel free to yell out or feel free to raise your hand, okay? So with question 5, I'm going to start with my PPP. So here I've got the relative PPP. On the left-hand side, I've got the expected spot rate in the future divided by the current spot rate. On the right-hand side, I've got 1 plus the inflation rate in country D divided by 1 plus the inflation rate in country F, okay? So the exchange rate here is written as D over F. So this is the price of currency F in currency D, okay? So D is for country D, and this is domestic. You can think of it as a domestic country, so Australia. F is for country F, so you can think of this as a foreign country. So I can rewrite the left-hand side, so I can rewrite this ratio as ST divided by ST plus EST minus 1, EST plus 1 minus ST divided by ST, okay? So this will become 1, and I can call this ratio as E, okay? So as you can see, E is the expected change in the spot exchange rate, okay? So E here is the expected change in the exchange rate. So I'm gonna call Q this ratio here. So what I'm doing here is that I rearrange. So from this equation, I will rearrange the PPP to get this ratio here. So I'm just gonna write down for you guys. So from the PPP, 1 plus E equals to 1 plus inflation D divided by 1 plus inflation F. Then I'm going to rearrange this equation. I'm going to divide both sides by 1 plus E. Okay, so I'm going to call this ratio Q. So Q here is my real exchange rate. So this is the true value of currency F in terms of currency D. And Q measures the degree of deviations from the PPP, okay? So write this down for now. I'm going to explain to you guys why later on. So Q measures the degree of deviations from the PPP, okay? So when Q is equal to 1, when Q is unity, then I can rewrite this equation to have the PPP, right? So when this ratio is equal to 1, I'm going to times both sides by 1 plus E to arrive at the PPP, okay? So in this case, when Q is equal to 1, my PPP holds. I'm going to do one more rearrangement. I'm going to times both sides by 1 plus pi F. So that on the left-hand side, I've got 1 plus pi D. And on the right-hand side, I've got 1 plus pi F times 1 plus E. Okay, so this is when the PPP holds, okay? So in this case, what we see is that on the left-hand side, we've got the expected price level in the domestic country. So 1 plus pi D is the expected price level in the future in country D. On the right-hand side, I've got the expected price level in country F, adjusting for the currency differences, okay? So one way to think about this is that if I am a domestic consumer, if I buy goods and services from country D, which is my own domestic country, I'm going to pay 1 plus pi D in the future. If I'm a domestic consumer and I'm going to buy a foreign good, I'm going to buy at a price of 1 plus pi f times 1 plus e. Okay, so this is the current price level in the foreign country, in the foreign currency. This is when I convert the foreign currency to the domestic currency. Okay, so this is how much I need to pay to the foreign trade partner if I want to buy their goods and services. So when PPP holds, that means whatever I pay in the domestic country is equal to whatever I pay in the foreign country. Okay. So in this case, the competitiveness of the two countries are exactly the same. So it doesn't matter where I buy goods and services from, I'm going to pay the same price. Okay. As a result, it doesn't matter for me as a consumer to buy from either country, either from the domestic country or from the foreign country. Okay. So in this case, the competitive positions of the two countries are in equilibrium. Now let's move on. Now, when Q is different from 1, so when Q is different from 1, when the PPP does not hold, this is when the PPP does not hold. Okay. So in this case, the competitive positions of the two countries will be different. Okay. So when Q is different from 1, this is when your PPP does not hold. Okay. So when PPP does not hold, this is when the real competitive positions of the two countries are different. Okay. So for example, if Q is less than 1, this is Q, right? So this is my Q. If this is less than 1, then if I rearrange the equation, I will find that 1 plus pi d is less than 1 plus pi f times 1 plus e. Okay. So in this case, now can someone tell me if this is the case, then as a consumer, do I prefer to buy goods and services from country D, which is my domestic country, or do I prefer to buy goods and services from the foreign country, which is country F? All right, so guys, tell me, I just launched a poll. Now, in this case, I've got 2 different countries, and as a consumer, do I prefer the foreign country or do I prefer the domestic country? I've got 1 answer here, which is the foreign country. I've got 2 answers for the foreign country. I've got 1 answer for the domestic country. Okay. Now, if you answer foreign, can you tell me why? And if you answer domestic, can you tell me why? Okay. Any volunteer, guys? So as a consumer, I want to buy cheaper goods and services, right? Here, I'm assuming that all the goods and services are the same quality. So as a consumer, if all the goods and services are the same quality, what I want is I want to buy a lower price, okay? If that's the case, then would I be buying from the domestic country or would I be buying from the foreign country? So in this case, I'm afraid I have to agree with the person who say yes to the domestic country, and I would disagree with the 2 people that say yes to the foreign country. Okay, so the reason is because the price in this country so the price in my domestic country is cheaper. And as a result, as a consumer, I am more inclined to buy goods and services domestically. Okay. In contrast with the foreign goods and services, I will need to pay a higher price for the same good or service. Okay. Do we see why here? Do we all agree? So as a result, there is more demand for goods and services produced in the domestic country or country D, and therefore their competitive position will increase, okay? So if you have more people demanding your goods and services because your price is cheaper, then that means your competitive position will increase, okay? So for example, if you think about the market for physical goods, okay? So where is it cheaper to manufacture goods and services? So at the moment in the current world economy, it's cheaper to produce goods and services in China or in Southeast Asian countries, so on and so forth, right? So as a result, people ship their production to these countries because they get to produce at a cheaper cost, okay? So as a result, we can say that for the physical goods market, it's more competitive to produce in China or in developing countries, okay, relative to more expensive countries. So we have just discussed the case with when Q is less than 1. So in this case, as Q is less than 1, you'll find that prices in the domestic country or country D is cheaper, and therefore their competitive position will increase, okay? We can do the same analysis for the case when Q is greater than 1. And in this case, you will find that the prices in the domestic country are more expensive, and as a result, their competitive position would decrease, okay? Any questions so far? Or are we all happy with question 5? Okay. So I'm going to assume that we are all okay. Okay. So as we mentioned before, in the interest of time, I'm going to skip through the other theory questions. And for the numerical problems, we will focus on problems 10, 12, and 8. Okay. So problem 10 is a new problem. Problem 12 is a IRP arbitrage problem, which we have gone through in the previous lecture. And problem 8 is also a new problem. Okay. So let's go through problem 10. Now, due to the integrated nature of the capital markets, investors in both the US and the UK require the same real interest rate, which is 2.5. So I'm going to call R as the real interest rate. And I'm going to say RUS equals to RUK. Okay. There is a consensus in the capital markets that the annual inflation rate is likely to be 3.5 in the US. So this is the inflation rate. I'm going to write pi US. And the inflation rate in the UK is 1.5. Okay, so pi UK is 1.5. So the spot exchange rate is currently 1.5. So this is my S0. And the currency pair I'm dealing with is the USD over the pound. Okay, so here the pound is the commodity currency and the USD is the measurement currency. Okay. So I've got 3 questions here, and I'm going to write them on the whiteboard so we can go through them together, okay? So if you haven't got the key information in the question, make sure you write it down or take a picture of this slide before we move on to the whiteboard, okay? So in question A, we are going to use the Fisher effect to compute the nominal interest rates in the 2 countries in question. In question B, we are going to use the, now you have to tell me that. So in question B, we are going to compute the expected future spot rate. And in question C, we are going to compute the forward rate, okay? So let's start with question A. So for question A, I'm going to help you write down the formula for the Fisher effect. So I'm going to have 1 plus I, which is my nominal interest rate. So I is for nominal interest rate, equals to 1 plus R for real interest rate, times 1 plus pi for inflation, okay? So I'm going to need you to help me compute the nominal interest rate in the US and the nominal interest rate in the UK, okay? So here, my real interest rate is, as given by the question, 2.5 for both countries. With inflation rate, the inflation rate in the US is 3.5, and the inflation rate in the UK is 1.5. Okay, so these are the questions, the information from the question. So based on this information, can you help me compute IUS and IUK? Okay. Okay, have we got an answer for me? What is IUS? So with the IUS, I'm going to write 1.025, which is this term here, times 1.035, and I'm gonna minus 1. So I bring number 1 from here to here. Okay, so someone tell me what is the answer here.
I don't know if this is right, but I got 6.09%.
With IUK, I'm going to write the formula here, and you will need to tell me the answer as well. Okay. Okay, did we have any guess, or have we computed? Have we done this question at home?
Is the UK one 4%?
So guys, you need to help me out here. I just need the 2 numbers. Okay. Yep, I've got 2 answers here, I guess. Zach, Jerry, so US 6.09, UK 4.04. Spot on, Zachary. Jacob 4%, for JC 0.04. I'm assuming that you guys talking about the UK rate, Jacob and JC. So Zachary, the answer is correct, right? Spot on here. No. Oh, okay. That's all right, Jacob. You can use the chat box. Oh, okay. Jacob, I can see that you are unmute.
Hmm?
And Zach, Jerry, I just unmuted you. Can you try again?
Hello?
Hello?
I can't hear anything. Oh, okay. That's weird. So I can't hear you guys.
Good.
I'm sorry, I can't fix this problem. I don't know how to fix it. Yeah, but you can use the chat box if you have anything to say. Okay. Yeah, I'm sorry. I don't know how to fix it. But I unmuted you guys on my screen. Okay, so thanks, guys. So these are the correct answers for the nominal interest rates in the US and the UK. So question A done. Let's move on to question B. So for question B, I want you to look at the summary slide that we looked at the start. It was in your lecture note as well. And tell me, I'm just going to share that with you now. And you need to tell me which formula I'm looking at, okay? So you need to tell me which formula to use for the second question, okay? So here are all the formulas, and let me start the polling. See. So I need you to tell me which formula I would be using for question B. Yep, I've got an answer here. Close, but not quite correct. FEP, no, the second answer is not correct. So we're not going to be using the FEP. FE, no. So the rate that I'm interested in is the expected future spot rate. So it will be EST. So it will be this one over here. Okay. So you need a formula that relates to the expected spot rate. Okay. Did we want to try again? I'm just going to relaunch the poll. Okay. So I need a formula that relates to the expected spot rate because that's what I want in question B. Okay. Fisher effects. Yes, sort of. It's relevant in this question, but it would not help me to compute the expected spot rate. The IFE, yes. So I've got, yeah, I agree with the IFE, which is the International Fisher Effect. Yep, I agree with you guys here. Okay. Yes, spot on. So I will be looking at the IFE, okay? I'm going back to my whiteboard. So here, what I'm interested in is I want to find the expected spot rate, okay, for the next 3 years. And from all the formulas I'm looking at, there are actually two that are relevant in this question. The first one I can use is, as you guys suggested, I can use the International Fisher Effect. So in this case, my formula would look like this. I'm just going to write S3 for short. Okay, so that will be 1 plus I US divided by 1 plus I UK. Now, an alternative approach is that I can use the PPP, the purchasing power parity. So in this case, the question gives me information for inflation. So I can also use the inflation rate to compute the expected spot rate, okay? Okay, so there are two different alternative methods, and doesn't matter which one you use, you should get the same answer, okay? Now, I'm just looking at the IFE here. So do you guys think that I can use the IFE as it is, or do you think that we need to modify the equation? Okay, is this appropriate to use in its current form? Yep. Would change the 1 to a 3. Yes, thanks, Jacob. Exactly right. So here you want a 3-year spot exchange rate. So the time horizon here on the left-hand side is a 3-year time horizon. So on the right-hand side, you need to have a 3-year interest rate. Sorry. So you need to have a 3-year interest rate. So at the moment, we only have a 1-year interest rate. Okay, this is the annual interest rate. So we need to do a modification, which is to take the right-hand side to the power of 3. Okay, to find the 3-year interest rate equivalent. So if that's the case, can you help me use that formula to compute the expected spot exchange rate for the next 3 years? So here, if I put everything in my equation, in my calculator, I will find that the answer here is 1.5904, okay? So just to keep with convention, I'm going to keep 4 decimal places for my exchange rate calculation, okay? Now, if we are going to use the PPP for this question, we should get the same answer as well. And similar to before, we need to adjust the right-hand side to take into account the fact that it's a 3-year horizon, okay? So we need to compute the inflation over the next 3 years. Oopsie, I think I've got a typo here. This should be inflation. Okay. Now, question C. In this case, I want the forward rate, okay? So for question C, can you guys help me to find the correct formula again? So from all of the formulas we looked at the start, which one should be the correct one? So here I'm interested in calculating the forward rate, okay? So I'm looking at this circle over here. IRP, yes, exactly, spot on. So I can use the IRP because I've got the nominal interest rates from the question, from question 8. I can also use the FPPP, so this is the forward purchasing power parity, because I've got the inflation rate in the question, okay? So thanks, guys. So in this case, I potentially have 2 different ways to compute the forward rate. I could use the IRP. So S1 divided by S0 equals to 1 plus IUX divided by 1 plus IUK. Okay. Now, do I need to do any modification here? Or is it okay to use the formula as it is? Oopsie, this is F, not S1. Okay. So for question C, now we are interested in the 1-year horizon. So this is the forward rate for the next 1 year. On the right-hand side, I've got the annual interest rate. So it looks like on both sides of the equation, I'm looking at a 1-year maturity, okay? So it looks okay to use. So if I rearrange, I will find that my forward rate here is this much, okay? So once again, we can use the forward purchasing power parity to compute the forward rate in this case as well. And we should find that we have the same answer here. Okay, so these 2 numbers should be the same. Any questions so far with problem 10? So in these kind of questions, the first thing to pay attention to is you need to make sure that you get the right order of the interest rates or inflation rates, so on and so forth. So in this case, because my exchange rate is USD over pound, okay? So as a result, when I write my IFE condition, the USD goes to the top and the UK goes to the bottom, okay? So make sure you don't mix it up in the exam or the midterm tests. The second thing to note is that you need to make sure you adjust for the time difference. So for example, in here, I've got a 3-year horizon. So I need to make sure that I convert the 1-year interest rate into a 3-year interest rate, okay? All right. So without further questions, let me move on to the next question. So we have about 10 minutes left. So in the interest of time, I'm just going to briefly talk through problem 12. Yes, I've got an answer, a question here. I can't seem to get the right answer for question 2. Do you mean question B in the previous question or question 2 in the tutorial? B? Okay. I'm going back to my whiteboard. Okay, let me do the calculations on my Excel. Give me a second. To the power of 3. Okay, so when you take this ratio, what did you get? So when I take this ratio, I got an answer of, so here, so if I take this ratio, I'll get an answer of 1.0197. Not with the interest rates on the other slide. So if you use this interest rate here, so this is 6.09%. So you're saying that if you use the interest rate that we computed in question A, you can't find the same answer? So this interest rate here is 0.06. Oh, okay, okay. Okay, that's the inflation rates. I guess you know. Okay, let me try again. So for the US, the inflation rate is 0.035. For the UK, it's 0.015. Jacob, I will get the same answer. So Jacob, if I use the inflation rates, I should get the same answer as well. I just double checked. Yes, exactly. So if you use the international Fisher effects, you need to use the nominal interest rate. Yep. Okay. Oh, good. Thanks, Jacob. So I'm going back to my slide. Okay, so with problem 12, so here we are looking at an IRP arbitrage question. So once again, we first want to check if the IRP condition holds or not. And depending on how the disparity looks like, you will determine where to buy and where to sell. where to borrow and where to lend. Okay, so you always want to borrow at a place where the interest rate is cheaper after adjusting for the currency differences. Okay, so you don't just compare the absolute interest rates, you need to compare the interest rates after you adjust for the currency differences. Okay, so try problem 12 at home, but for the interest of time, I'm going to go straight to problem 8. Okay, so problem 8 is not too difficult, but it takes a bit of time to get used to it. Okay, so in problem 8, we are given a few macro economic information, and we need to compute the following rates. Okay, so the exchange rate that we are looking at here involves two currencies. The first one is the South African Rand, so ZAR, and the second one is the USD. Okay, so in question A, we are asked to compute the current ZAR spot rate in the USD. So when we say the ZAR spot rate in the USD, we are talking about the value of the ZAR in the USD. Okay, so the exchange rate that I'm looking at here is this one. Now, in question A, we are interested in the current exchange rate that would have been forecast by the PPP. Okay, that means we are looking at S0 as if the PPP holds. Okay, so what is the S0 implied by the PPP? So with the PPP, you've got two forms. You've got the absolute PPP, which is based on the price level, and you've got the relative PPP, which is based on the inflation. Okay, so in these questions, you're given both information. You've got the price levels and you've got the inflation rates. Okay, for the purpose of question A, now because we want to compute S0, which is the value today, we cannot use the expected inflation rate. Okay, that's because the expected inflation rate is for a future calculation. Okay, so if you want to compute a future expected spot rate, then it's appropriate to use the expected inflation rate. But if you want to compute the current spot rate, then it will not be appropriate. Okay, so that's something you need to pay attention to. So for question A, therefore, I cannot use the relative PPP because the inflation numbers here are not appropriate to use. So I'm going to resort to the price levels then. So looking at these price levels, now it's a bit tricky here because with the PPP, the absolute PPP, this is your formula, right? So the current spot rate is equal to the price level in country in the US divided by the price level in South Africa. In the formula, these price levels are the absolute prices. So they are in dollars, for example, for the US, or in the ZAR for the South African currency. Okay. The price levels here that we have in the question are not absolute prices, they are relative prices. Okay, so for example, if my base price level is 100, then my current price level is 105. That means my current price level is 105% of the base price. Okay, so for example, so you can think of the base price as something like a historical price. Okay, so this could be something in the past. So for example, in the US, if the base price is say 300, then this 105 number tells me that the current price is 105% of 300. Okay, that means the current price levels in the US is 350. Okay. So as a result, when you want to use the PPP in this question, you need to modify it to take into account the fact that these price levels are relative, and therefore to compute the spot rate, you need to times the price ratio by the base rate. Okay, so you need a base rate number here to compute the spot rate. Okay. So in this case, the price level in the US is, as we mentioned before, is 105%. So where did I get this number from? It will be 105 divided by 100. Okay, with the 100 being the base price level, and 105 is the current price level in the US. With South Africa, we are going to do the same thing. We're going to take the current price level and we are going to divide that with the base price level. Okay, so that will give me the relative price level in South Africa. So I would then take this relative price ratio and I want to times it by the base spot rate, which is here. So the base rate is 0.175. So if I do so, I can find that the current spot rate as implied by the PPP should be 0.1655. Okay. So it takes a bit of time to understand this question because it's a bit tricky to understand these macroeconomic indicators, okay? But this is basically what it means. So we only have a minute left, so I'm just going to talk through questions B and C. So with questions B and C, it's a bit more straightforward. So you're told to use the IFE to compute the expected spot rate 1 year from now, okay? So with the IFE, you need the interest rates in the two countries, and here you're looking at just a 1 year time horizon, okay? Question C, you're going to use the PPP to compute the expected spot rate 4 years from now. So because this is an expected number, we can't use the current price levels, so the absolute PPP is not relevant. We are going to use the expected, we are going to use the expected inflation in the relative PPP, okay? So it's a 4 year time horizon, so you need to adjust for that time, okay? We are right on the dot now, so is there any last minute question or comments before we conclude? If not, I'm going to conclude the tutorial for now. Thanks guys for joining in today. And if you have any questions, once again, feel free to email me or ask me in the consultation time, okay? So make sure you go through these questions because they will be relevant for your midterm, okay? So thanks again, guys, and I will see you in the lecture later on.